Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Sebastian, welcome to this live webinar, mate. It's great to have you with me.
Yeah, thank you. No, thanks for putting it all together.
Yeah, no, it's I can't take all the credit. Ange behind the scenes at NAOS has done a wonderful job, and we've got some fantastic speakers for everyone today. And I think it's going to be a great conversation about small, medium, emerging businesses, about distribution businesses, logistic businesses. So anyone that's interested in small cap investing, even mid cap ASX companies, we've got everything today. Mate, maybe just to kick things off, because we will open the floor to questions through some of our panelists as we go throughout the next hour. Can you just maybe give us an introduction to yourself and the NAOS brand? And I've got a few slides here that I'll step through as we get into it.
Yeah, thanks for the intro. So I'm a bit of a unique example. I've been at NAOS for 16 years. So when we started NAOS, we ran roughly, I think it was $10 million in funds under management. Today we run over $300 million. But what hasn't changed, I suppose, is we invest in emerging businesses, listed, but now also unlisted emerging businesses, and probably more of a slant of, they're very much cash flow generating businesses, as you'll see on with some of the speakers today. They're real, tangible businesses. A lot of the time they're founder led, and we obviously have 3 listed investment companies, over 7,000 shareholders, I think, today, and very much concentrated on taking large, what we believe are quite strategic positions. We'll often own 15 to 30% of a business and like to back people with great businesses, with the competitive advantages in great industries, and want to let our capital compound, hopefully, for as long as humanly possible.
That's great, mate. So maybe I think when we set about doing this webinar today, we really wanted to illustrate both to the Rask and to the NAOS community the types of things you look for and the businesses, and illustrate and hear from these businesses and the people that run them. But you'd obviously do that through the listed investment companies. You've got the private opportunities fund as well. Yeah. You mentioned you've been doing this for quite some time, which stands out to me as someone who interacts with a lot of fund managers and investors every day. That's quite a tenure, mate.
Yeah, no, it is. Yeah, and I think you made the comment at the start. I think we've never done one of these webinars before, but I think for all the listeners, it's quite interesting because, as you said, and I think David said before we jumped on, it's not going to be so specific. We're just not looking at a company's financials. I think people get quite obsessed with a company's financials and performance and things like that. I think this is a fantastic experience for people to listen to CEOs who happen to be running businesses in this case that I think have got quite a very in-depth sort of feed into the economy. Like the unemployment figures were just out. I think we'll be able to ask or get some great feedback on, how the economy is travelling, what they're seeing from their customers, how they're reacting, how they're changing their businesses, and how they're planning for the future, as opposed to people just focused on, what the next quarterly profit figure is going to be. Which for me, I think is quite interesting.
Yeah, we're going to cross to David in just a moment, but really quickly, we just had one very quick question come through, Seb. It's just, can you just describe the different funds here? They're just shown on the screen in front of us. So I probably should have jumped to this first, but can you just walk us through those really quickly?
Yeah, no, I get this question all the time. A lot of people say that there's not a whole lot of difference, and I think I make the big disclaimer that the philosophy is exactly the same. That's something we're very proud of. So they're all very long-term focused funds. All the same type of investments, they're cash flow generated businesses. The only thing that really changes across each of the LICs is the size of the business. So NAC will often have the larger businesses, so mid cap. NSC is small cap, hence the S. And NCC as our first fund is what we call micro cap, so the smallest businesses with the odd private business in there. But the philosophy is exactly the same. It's just really the size of the business that changes.
Yeah, great. Well, wonderful, mate. We'll cross back to you in just a few minutes. But we'll also have some more information, and there is a link in the episode or video description. So if you click the link in there after the recording is done, you'll be able to learn more about the NAOS business and everything that Seb and the team are doing. But mate, I might say goodbye to you and usher in our first guest, if that's okay. Thank you very much. Although I doubt he'll need it. So here we go. So David Dicker, founder, CEO, chair of Dicker Data, trades on the ASX under the ticker symbol DDR. Welcome to the webinar, mate.
Yeah, hi. Thanks.
We had a brief chat just off air before, but this is the first one we've done in person. Although I have heard a lot about you and followed you from a distance for quite some time. I know many of my analyst friends follow your business. But one thing that's more personal, mate, is I often, when I was like doing a bit of research into you, I noticed that alongside running the business, there's so many other things you do. And one of those things which I heard is this kind of this fascination and interest you have in racing, whether it's boats or cars or whatever it may be. But I also heard that you're one of the world's largest collectors of Ferraris. And so I'm curious why that is.
Well, Ferrari's the best car in the world. Simple as that. It's the best brand in the world, and they make better cars than anyone else. Just that's the way around it, really.
What is it about the brand in particular?
Well, how many other car companies have got a guy like Enzo who started it? You look at the other companies and they just don't compare there. I mean, Enzo was a larger than life character. He drove the whole company forward, blah, blah, blah. And they're Italian, so they have passion. And, passion's important in life. And they're more passionate than, obviously, Porsche and the English guys. And so that adds excitement. And they're never afraid to build a different car. Like, I've got a fair few McLarens, and the McLaren's a good car. But, geez, you line them all up alongside of each other, and they're hard to tell the difference. Ferrari never make two cars the same. And every now and then it won't be quite as good, but every new model is different to the previous cars, and they're going to be always out there with new stuff, interesting stuff. And the company was really transformed in the 90s when Mr. Montezemolo took it over, and he basically built it into the company that it is now. Look, it's the best car company in the world.
We're going to be talking about a lot of logistics and things today, but I just had to ask you that question because when I heard about it, I just I couldn't quite. I had to hear it straight from the horse's mouth, so to speak. But mate, for most people that probably watch this will.
How many cars I had?
Yeah, how many cars?
No, don't worry about it. It's a joke. I'm sure there's tons of guys in Europe and America that have got much better collections of cars than I have, and especially the older cars. But I reckon I do have one thing that most of them would struggle to beat is I still own every single new Ferrari I've ever bought, and that goes back to 95, 96.
This is great. I mean, we could talk about this and a few other things all day long, but one of the things that I've got to ask is basically for you to just give us the bird's eye view of Dicker Data. A lot of people know, you or the business from a distance at least because of the ASX listing, but can you just take us through like the business overall, what you do and who you serve? And like my understanding is it's business to business, B2B, but can you just set the scene for us?
Yeah, well, we're an IT distributor. So computers, communication, software. We started doing that in 1978, and we're still doing it. Basically, we're in exactly the same business today that we were in when we first started, and it's 45 years ago. And we've just concentrated on doing the job as well as we can over all this period of time.
In a previous interview that I saw that you did, you mentioned that I guess that there are competitors and they're multinational competitors, they're overseas competitors, and you mentioned how your local knowledge is your advantage. Can you talk to us about that? Because a lot of people would look at the business and be thinking, well, how can you compete when there are these, there's the giant suppliers and Apple's, Microsoft's, but then you've also got pretty strong retailers and distributors around the place as well?
Well, our advantage comes from different strategies at the business level, because let's face it, our competitors, they have access to the same product. So we have no gain on the product side. Our gain is the strategy of our company, the structure, and the way we operate the company. And we have developed all these ideas ourselves. Obviously, I'm an Australian, we're an Australian company. So they are automatically tailored towards Australia, whereas our foreign-owned competitors, all their strategies are driven from offshore places that have got different cultures, different approaches, and they just have different strategies to how things ought to be done. So we've done it our way and they've done it their way, and then you just look at the result.
It seems so simple when you say it though, right?
Yeah, but look, in the final upshoot, it only really comes down to one thing: runs on the board. Like, I can remember going back to when Compaq bought DEC. DEC was the second biggest computer company in the world at one time, and the two companies combined, I think, had 14 distributors in Australia. Now, that wasn't going to be a long-term go-forward situation, and the betting in the back of ARN didn't put us in a good spot to get across the line, but we actually got the heads up before they actually made the official agreement that we would there, and only for one reason: because we had the runs on the board with sales. We were moving product, and that's what you have to do in the final upshoot. You can make headway with relationships and all the other stuff, but in the final upshoot, numbers are what come down to it, and that's sales and profits.
Well, I've heard you talk about this before, but another thing that I've heard you talk about in this respect is the value that you place upon people, right? You talk about relationships. One question that a lot of people ask any CEO or any founder is, how do you find great people and how do you keep them? And how do you create that environment where they want to be?
Well, our top executives are exceptionally well paid.
That helps.
And I'm a big believer in self-interest, because I'm a realist. It's okay, we can talk about all kinds of stuff, but in the final upshoot, if you want to motivate people, you need to appeal to their self-interest, because that's just life. That's just the reality of life. And so you get good people. That's the first step. And then you remunerate them. And then they make an effort, and the guys they've got under them make an effort, and you get the outcome.
Do you think about, how do you think about variable components in, say, like commissions-based things versus, say, this Netflix culture of pay the maximum amount all the time in a base rate?
Look, you can't. You got to be sort of flexible on these kind of things. But look, we distribute a decent percentage of the company's profit to the management guys, basically. And so they have an incentive to get an outcome, and that's basically how we do it. Obviously, the base pays are still solid, but the gain on performance is where the benefit's going to be.
I watched an interview of you previously where I think you made a reference to Charlie Munger's idea of that one day you'll die. It's basically just like, tell me where I'm going to die and I won't go there. And the power of incentives obviously is really important. But another thing which I'm curious about and hoping to pick your brain on is just how far ahead you think in terms of strategy. We had a brief discussion off air about this idea that no one can predict the future, but I feel like it's, to some extent, you've got to.
I basically have a 12-month time horizon in all aspects of my life. I don't really like to think beyond that, and because you can't predict beyond that, and you can spend a lot of time on it, but it won't work out well. So in the business, we do a 12-month projection for each year. We operate a calendar financial year, and that's how we operate, and we've done that for a very long time, and that gives you a good structure. It works well, and it fits in with the way I approach life.
We'll get to some questions in a minute. I can see quite a few have already come through, but there's one more big one from me, David. It's just, I follow, my background is technology, and I follow a lot of like software businesses, a lot of platform businesses, a lot of cloud-based businesses really closely. And obviously the shift from on-premise to cloud-based tools has had a profound effect on the way business is done, whether people are working remotely, software engineering, so on and so forth. I'm keen to understand how you think about that transition and the impact, if any, that it might have on the business and the industry, I guess.
Yeah, but you're still basically running the same software. So whether you've got it on your desk or you got it at the end of a wire, your operational situation's not really any different. You get a few advantages from doing it on the end of the wire, but you could have it on the end of a wire into your own building or out in the cloud. So I don't find those things to be massively pivotal. The real, like we started when the personal computer started, and the idea was that you had your own computer instead of, having to go through a computer room and all the other crap. And that was the real revolution. And we're still basically in that. These other things are just sort of detailed variations on how the revolution's delivered, but it's still the same, because look, your phone is now basically the way the personal computer was. It's your own device, and you have connectivity, which we didn't have in the early days, but nothing's really changed there. It's moved around a little bit, but I don't think any of those things are sort of massively pivotal. The only minor sort of differences are the privacy equation, because obviously when you go to the cloud, you potentially give up on the privacy side. If you run, in effect, your own, but you ran it in exactly, then you can maintain that. That doesn't seem to be many people are concerned about, but that's the only really operational difference. One day the government's going to want to dig into that stuff.
Okay, one final question for me is, like, obviously you came out with an update recently which showed some pretty strong top line growth, obviously a benefit from some acquisitions and so on. But just, I guess, generally speaking, COVID had an impact on supply chains. I noticed that was called out in the update, as you would expect. So I think one of the questions that I pre-prepared was just, like, I don't like to focus on myopic things, but some of the things that are on your mind right now in terms of challenges in 2023, is it still the thinking around supply chain and making sure you can fulfill order books? Is that kind of something that's like prescient?
Well, it's nowhere near as big an issue as it was. So we're probably, it's still a problem, but it's coming to an end, and it's receding in the rear vision mirror pretty quick.
Yeah,
really.
Great. Okay, so we've got some questions that have come through, and just for anyone that's watching live, there is an opportunity to ask our speakers and panelists questions in the last 5 minutes of each slot. So I can see some have come through. Please get more if you have them. David, one question come through, and this one's more personal. It's what does the succession plan look like, and how many years do you see yourself being at the head of the business, steering the ship?
Well, my grand, so with that, I haven't got into leave the business or become sort of less involved. I'm not required at a day-to-day level. I mean, obviously, I did all that stuff in the long distant past, but our management guys run the company day to day, and my job is to really just maintain the line on strategy and come up with a few new things every once in a blue moon, and just make sure that we basically stay on the strategy, because that's harder than you might think, because you get into weaker economic times like we are now, and you'll get calls for things like, oh, we should cut the dividend, or we should do this, or we should do that, and blah blah blah. And it's real easy to just, oh yeah, okay. But the problem you've got is long-term success is built on the correct execution of long-term strategies. Now, if you move around all the time, that's just a weak that's a weak strategy in itself. So you just got to hold the line. Company's just built on a couple of pretty simple and straightforward sort of financial pillars, and I'm just not going to deviate from those because we've been doing it for so long that they work.
Yeah, I once had it put to me, David, that great ideas are cheap, well executed ideas are very expensive, and it seems like you're in the latter camp there for sure. There was another question that come through
One
from
of the things about it is that when I was a kid, I thought, sorry to butt in, but
no worries.
I thought having the ideas was the big thing. But as you get older, you realise that it's not actually having the ideas, it's actually being able to execute them that really is the tricky part, and that's the hard part because most people can't execute them. There's a lot of people with ideas and they don't execute. So in the final upshoot, execution trumps all.
Well, and you said it before, right? Where you said that like you had runs on the board, and that's what those runs enabled you to get more runs. And I couldn't agree more for what it's worth. I'll just quickly sneak in one final question here, which comes from FOTS and just said, do you have any intention to expand the retail sales segment that you recently acquired?
I'll be honest, I've never been a massive fan of retail. The margins are low and there's a lot of issues that you have to deal with. And to be successful, you really want to have a tight focus. And the focus that we've had has been tight and it's been successful. We do sort of consumer and retail stuff in New Zealand, especially because we inherited it. And we got a little bit of it in Australia, but I'm not sure that it's an area that I'm really breaking my neck to get into, to be honest.
Yeah, fair enough. Well, I do appreciate you taking some time out of your busy day, mate, and joining us. Hopefully there's a round 2 in the future, but thank you for taking some time. I know you're a busy man, so really appreciate it, and enjoy the rest of your day, David.
Yeah, thanks very much.
Okay, thank you to David for joining us, and thank you for the questions that have come through. I'll now welcome Sebastian back into the chat, and he'll introduce our next panelists and speakers. Seb, over to you, mate.
Cool, thanks, Owen. So joining me now, hopefully with a bit of luck, is the current Executive Director of Move Logistics, Chris Dunphy, as well as Peter Loy Maranta, forgive my pronunciation, Pete, who's currently the CEO of MaxiParts. Obviously, we're both an investor in both of these businesses. So, gents, really appreciate your time. Thanks for jumping in the deep end. Probably not something you do every day. So thanks for sticking your necks out. I might just get straight into the questions, to be honest, because I know we're strapped for time. So I'll jump in with one question, and I'll let you both answer it. I'll start with you, Chris. Obviously, Move Logistics, somewhat of a turnaround, but it would have a great, I suppose, feel for the New Zealand economy anyway, which will be slightly different to the Australian economy. But from your perspective, what are the main sort of items commanding your attention today, based on sort of dynamic economic environment in New Zealand?
Yeah, thanks, Seb. Thanks for letting us come on and have a chance to jawbone. Look, we're a service industry. Our demand is derived from our customers' needs. If they don't need stuff moved or stored or shipped, we don't have much to do or talk about. But the real driver for us at the moment is getting the migration settings working again, so that we can get the right caliber of people into jobs. That also flows through to our manufacturing customers. We're all struggling with New Zealand's migration settings, which are significantly worse than Australia's. And really we've got this double bind, particularly in terms of wanting to continue our transition to owner drivers, where we need those migrants as a pool of potential partners for us in the business.
Yeah. And Peter, obviously, I think you've got over, from memory, 12,000 customers, probably some customers like Move in many respects. So you also would have a pretty good feel for the economic conditions. Sort of what's commanding your attention more recently?
Yeah, well, similar. So staffing and staffing levels. So a lot of our customers are struggling with staffing rates, and our business is struggling to find simple warehouse staff. So certainly staffing is a big issue. We import a lot of product, so everyone knows about the supply disruption. So a lot of time managing the supply chain and making sure we've got appropriate stocking levels. So not blowing the cash flow and balance sheet out, but making sure we can support customers. And I guess most recently, lots of inflation and cost pressures. So making sure we maintain margins and pass those through where we can.
Yeah. Okay. And I'm just going to go off piece a little bit here, but obviously a lot of the press is quite negative. It feels like there's a lot of doom and gloom around. Maybe since obviously you're both quite experienced, but I'll start with Chris. In your view, reasons to be optimistic? Like if you take a medium to longer term view, in your view, as an owner and a runner of a business, reasons to be optimistic?
The only benefit of grey hair, Seb, is that we've sort of seen this before. I mean, for me, this has sort of real sort of deja vu all over again of the early 90s. We got through that. The weak competitors, slipped on the banana skin. The strong folks just kept going, and the reason to be optimistic is to be able to look through a cycle. Those of us who have seen double-digit interest rates aren't scared by this. It's just you just hunker down and tough it out.
And Peter, for you?
Yeah, look, I agree, and we tend to operate in a market where the cycles aren't extreme. Transport it's increasing every day. The demand stays there. The fact that the market's remained as buoyant and strong as it has in the last 3 years, when you take account some of those macro factors of COVID, supply chain disruption, inflation, I probably would have expected more disruption. But it's remained strong, so I agree. I think it'll continue to improve.
Yeah. And I'm going to steal one of Owen's questions because I noticed David's answer to this might be quite different to yours if I was to hazard a guess. But in regards to strategy and how far you both look at, Chris, again, I'll start with you. How far you are 12 months or 3 years or 5 years? What works best for you in your sort of experience?
It's you've got to be able to adjust the strategy to suit the changing conditions. I mean, you can have a strategic plan, but you've got to be able to have that torn apart and shouted down. If people in your team come up with alternative narratives and viewpoints that are just better than yours. There's no monopoly on common sense, and therefore there's absolutely no way that we're going to sort of pin our colours to a mast and say we're staying on true north when actually we should be going west.
Yeah, okay, that's good. And Peter?
Look, similar. So we certainly look at a 3 to 5 year window. We think it's important to coordinate some of those shorter term initiatives into a longer term goal. We formally review it every year. So we have a board and exec workshop that adjusts that strategy as we need to. Obviously, we look at different initiatives every month and make a decision and a change if we need to. But we do think it's important to have that 3 to 5 year horizon to coordinate some of those shorter term initiatives. But as things change, world changes quicker than it ever has before. So staying flexible is certainly pretty key.
Yeah. And sort of moving on to technology, there's been a lot of sort of discussion about obviously technological change affecting business, open AI. Unfortunately for me, I think a fund manager or a stock trader, they say I think we're the most susceptible to being replaced by a robot. So I'll probably be out of a job sooner rather than later. But maybe Pete, starting with you, how do you see, I suppose, how has technology affected your business today, and how do you expect it to change any facets of your business in the future in a meaningful way?
Yeah, look, it's definitely enhanced our business. We've got 150,000 different parts in our database, and we service vehicles across all makes and models. So data becomes pretty important. I think AI is actually going to make a fundamental change and help us. One of our key issues at the moment is finding experienced parts interpreters who can interpret the needs of the customers, and they pull it out of their mind. So at the moment, it's a differentiator, having those strong staff members to leverage it. AI will start to fill that void, which means it'll put the pressure on other parts of our business in terms of service levels, pricing, product range, but I certainly think AI is going to help that detailed parts interpreting process in the medium to longer term.
Okay. And Chris, I know you're going through a little bit of a technological uplift in your business. What other sort of, I suppose, what facets of your business will technology change?
Yeah, I think it's interesting that what I see and I think what we're going to see in service industries like airlines and others is a huge amount of chatbot type AI development replacing frontline customer service. What that's going to lead to, I think, is a lot of homogeneity in terms of what sort of service people are getting from big organisations that grab AI in a sort of a first mover way. I think it's very important, in the service industry that you maintain your points of difference, and that doesn't necessarily mean not embracing AI, but being very clear about how you implement it. So I see that there's plenty of traps in terms of the implementation phase there. In terms of our business with IT, yes, obviously the sort of the bigger sort of digitization journey is something that all data hungry businesses have to really put a lot of resource into, and we're as much about moving information as we are about moving customers' freight, and so it's how we use that, interpret it, and give it back to the customer in a meaningful way that's important.
Yeah. And in regards to, it's probably a bit of a more macro question, but Pete, I'll start with you. There's been obviously post the budget, sort of been viewed as the budget didn't have a whole lot of anything that really, I suppose, stood out. From what you see in your business, if you were to make one or two suggestions on, sort of government reform to sort of stimulate certain areas or make things easier for your business longer term, I suppose, what would they be?
Look, I think there was a little bit about fuel in there, and that seems to be the most negative impact for transport operators at the moment is the fuel. So, our industry, it's more consistency in time. So, it's when there's those short, continual changes that it impacts people, impacts customers' profitability, etc. When the changes come in and there's, a bit more visibility and time frame, it allows people to build those into future contracts, etc. that maintains profitability. So, certainly consistent regulations or changes with a reasonable lead time certainly help everyone adapt and remain profitable.
Chris?
Yeah, similar. I mean, the challenge for governments is, they can tax to disincentivize behaviour. They can provide subsidies to incentivize behaviour. It's getting that mix right across a whole host of things. So, yes, in terms of alternative fuels, whether that's hydrogen or electric vehicles, there's a heap that the government can be doing. It's got to be a state and federal lockstep change to be meaningful in an Australian setting. Across Australia and New Zealand, again, I just keep coming back to the skilled migrant point, but also education. We should be getting more students into Australia and New Zealand and giving them residence based upon study. Stop this constant spin cycle of coming in, doing their degrees, and then heading off overseas. Give them residence, give them subsidised education with a bond or whatever, so they stay here. I think that's a really easy but quite a key thing for both economies to do.
Yeah, okay. Maybe last two from me before we go to questions. One, again, it's a bit out of left field, but it was mentioned by Owen before. And one thing we struggle in here a little bit as well. So incentivising staff, but I suppose maybe more specifically, there's a few grumblings about this, sort of incentivising and keeping younger staff. I've always struggled with it, even though I'm quite young, but especially those, Generation Y and Z. How do you think about that, and what do you think it actually is effective for making sure these staff are not only keen to stick around, but I suppose enjoy what they do, but have a balance in life? I'll start with Pete. Sorry.
Yeah. Look, there's lots of different non-monetary factors that kick in. I think we're seeing younger staff wanting to progress their careers fairly aggressively, in a more aggressive manner than they might have previously. So certainly making sure that we're clear about those opportunities, being fairly visible about what the opportunities are. And it's not just an opportunity, the next roll up. They tend to be looking what's the next 3 rolls up type scenario. So I think that's certainly the most effective way of putting people into a career path and helping them manage through that, not just one step, but a couple of steps up as we can.
Okay. Chris?
Yeah, I think you've got to create points of difference. The most successful businesses globally, I believe, are those that sort of create alumni effects amongst their teams. And that's not just for the current employees and team members, but people that have left. And creating a sense of belonging and also a willingness to sort of bring them back in once they've gone, elsewhere or overseas or that, I think is, moving towards a far more inclusive sort of culture where, it just helps retention long term, even if it means that, it's not continual, but it's there.
Yeah, okay. And maybe a slightly strange question, but Chris, I'll go back to you, but if you could change, I'm sure you're going to say I could change more than one thing, but if you could just change one thing about Move today, what would it be?
Oh shit! I mean, we own far too many trucks, mate, and I'm sure that's terrible news for MaxiParts. But we just want to be asset light, and the quicker that we can get on that journey, the happier I'll be. As are Craig Evans, who's the new CEO, and his team. I mean, we absolutely understand that we're good at moving freight. We're not good at managing assets, getting the last 5,000 kilometres out of a set of tyres, or the realigning our own brakes and slake adjusters and camshafts and things. For us it's not about the mode, it's about the outcome, and we can do that far better if we're asset light.
Yeah. Okay. And Peter?
We've probably got a few product groups that operate at lower margins than what we'd like. We've historically had them. They make up probably a little bit too much of our product mix at the moment. So certainly not necessarily giving up those lines or the volume they have now, but growing some of the more higher margin product groups to help balance out and get some margin leverage back into the business would certainly be the key priority.
There's only one question, so maybe I will throw in one more question, just because I know it'll relate to both of you. But obviously, fund managers talk about M&A a lot. I know, Peter, you've completed 2 recently. Chris, I know you've got a fantastic record at M&A. Not so much, I suppose, the integration, but starting with you, Chris, how do you think the best way to go about M&A is? Like, I know a lot of people talk about processes, running competitive tenders, I suppose forging a relationship with the vendor. In your view, I suppose, what's the recipe for success for a sound acquisition?
Look, every great deal I've done was with a motivated vendor, and generally it involved taking over something that was, if not hemorrhaging money, about to start hemorrhaging money, and that's why I love the part of the cycle that we're moving into now, because the motivation for vendors becomes a lot greater as interest rates go up, inflation goes up, and it just the general feeling in the market is gee, it's tough to make money. So that's buying well for me is buying when there is not a whole bunch of competitors lining up saying we'll have a crack at that. And understanding the risk profile of what you're buying.
Yeah, thanks. That's great. And Peter?
Similar, I think. Really understanding the vendors, getting as much information about the people in the business as you can. For us, an acquisition is great, but it really needs to meet a strategic objective and a financial objective. So you need to be disciplined in how you go about assessing and what you buy. And the other key one is being realistic in the benefits and the synergies. Everyone goes in and just assumes it's going to be fantastic and everything's going to work. Not everything works. So you need to be realistic about what you think you can do to add value to that business.
Yeah, okay. And I'll just finish with, it's just one question, and it's actually for Peter, and it's quite a specific question, so I think it's from someone who most likely knows what they're talking about. Apologies, Peter. So the question is, with the recent acquisition of Forsh, is the plan to focus on penetrating the repair workshop segment rather than fleet managers?
No, look, we already, if you look at the commercial vehicle market, we've got a fairly broad customer segment. So we do deal a lot with independent workshops, we do a lot with fleets, resellers, etc. So Force, we think, is an opportunity to add scale to a really good business that's predominantly in Western Australia. There's a number of customer relationships in the heavy space that we can add into the Force model, but Force has a significantly broader customer base, the automotive workshops, mining services. So we certainly don't expect to take a MaxiParts operating model and push it into an automotive workshop. We certainly think there's the benefit to introduce Force to some of our commercial customers and continue to have Force doing what it does well, which is that vendor managed inventory, mainly for workshops across all different segments.
Yeah, okay. Well, gents, obviously want to thank you for this, for everyone on the call, on the webinar. Want to thank Peter Loimaranta, who's the CEO of MaxiParts, Chris Dunphy, who's the Executive Director of Move Logistics. It's been a pleasure having you on. I've got a lot out of it. And obviously, all the best for the rest of the financial year, and I will be talking to you soon.
Thanks, Seb.
Thanks. I'll hand it over now back to Owen or Rob.
G'day, guys. I am just having some slight issues here with the mute. I've just been muted, so sorry about that.
Oh, can you hear me now?
There we are. Yeah, I can hear you now. So
that was me. My bad. So sorry, guys. I was trying to type away at my notes really quickly and keep some notes. And as I was just saying to myself, by the sounds of it, we'll be having a bit of a summary at the end with Seb. So thank you for that, Seb and Peter and Chris. So, mate, I'll leave it to you to introduce your panelists and speakers. But once again, I'll just make a call out. Please send us through your questions in the chat, and Rob and the team will field those later on. So, Rob, over to you, mate.
Thanks very much, Owen, and thanks for everyone for dialing in today. I'll just quickly introduce both Andrew Bennett, the CEO of Consolidated Operations Group, and Paul Mitchell, the CEO and founder of MitchCap. Welcome, gentlemen. Thanks for joining us today.
Hey, Rob.
G'day, Rob. How are you?
Yeah, very well. Thanks, guys. I'll just do, as I said, a quick intro. So COG, for those who may or may not have heard of the company before, it is an ASX-listed microcap business which operates predominantly in the finance, broking and aggregation space. They are the dominant player in that sector, and Andrew has been CEO and involved in that business since 2018. He's got a long history in the financial services sector and started his career out at KPMG. And with Paul, he is the founder and CEO, as I said, of MitchCap. MitchCap is the major floor plan financier for the recreational vehicles industry. So I think when you walk into a car dealership, what's on the floor there? It's everything but not cars. So I think motorbikes, caravans, areas which are far less competitive. Paul founded that business in 2019, and before that had a career at GE, which was previously a player in that sector. Gentlemen, as I said, thanks very much for joining. I'll dive into the first question, being around, you've both got reasonably long careers in the respective industries that you operate. Probably not as long as David Dicker, who has been around since 1978. And I think I heard on a podcast once, he started his business when Microsoft had only $8 million of revenue, which is quite outstanding. But you haven't been around that long. But Paul, you've obviously seen quite a few cycles in your industry. Specifically, COVID would be one that comes out to mind. And Andrew, you've seen plenty as well, most notably probably the GFC, where lending effectively stopped overnight. So I just want to get your guys' thoughts. Andrew, I might start with you around how you're seeing the current economic climate, and if it kind of, I suppose, relates or it reminds you of any other periods throughout your career. If so, why? If not, why not?
Well, COG's effectively got two segments, two businesses: asset finance and broking and aggregation, but then retail funds management and lending. So, but in both of them, it's unique in that even with higher interest rates, a tightening cycle, activity is really strong. I mean, the other guys touched on it. We primarily operate in the SME sector, and there's some really significant tailwinds pushing us along. You've got we've talked about population. We've got 3 million people coming into Australia under the government's estimates in the next 10 years. I mean, it's a city the size of the Gold Coast and Brisbane that's got to be built in the next 10 years. Roads, hospitals, railways, power stations, all sorts of stuff's got to be built around Australia to accommodate and service these people that are coming in. So that's all, great work for SMEs, because it all flows down to Australia's SMEs. We've also got, the thematic of decarbonisation and electrification, power stations turning off, power lines and new stuff being built all over the shop. And we've got, the mining industry and the agricultural industry very strong. So all the traditional users of Australian SMEs are incredibly strong. So even over the last 12 months, in the face of a number of interest rate hikes, the underlying activity in our segment continues to grow. So our volumes are still very strong. We've had a little bit of margin compression, as rates have gone up. The brokers, intermediaries get skinned a bit. But in terms of the underlying strength of the economy and activity in our sector, it's incredibly strong. And frankly, a bit surprising, given the government's or the RBA's intent to slow things down. So in my world, it's a bit unique.
Okay, thanks for that. And over to you, Paul.
Yeah, thanks, Rob. Pretty similar to Andrew, to be honest. And I think, all the CEOs that have been on the call this afternoon, you can hear there's still a level of optimism, I guess, leadership level across businesses about what's going on and what they're really seeing. So it does make me think a little bit that, when there's some negative economic data and there is some genuine headwinds in the economy, we do as a nation, I guess, as human beings, do become a little bit too Notre Dame-like and tell ourselves that the world is probably worse than it is. You mentioned, us trading through COVID. We've only been around since 2019 as MitchCap. In March 2020, I always think back to that. We had, lines of people around at Centrelink, around the buildings. No one knew what was going to happen. That was followed by a period of significant government monetary stimulation, which actually saw, particularly in the industries we service, caravans, boats, motorcycles, and even agri for that matter, with all the rain last year, massive demand for equipment, and coupled with the impact on supply, an economy that we're never probably going to see again. So if I fast forward to today, we're still in a really, really unique environment. I don't think it's like anything that would have occurred before. You've still got this hangover of monetary spend driving reasonable demand. I mean, our book was turning, we fund inventory. That book was turning 6-7 times a year at the heart of COVID. It's still turning 4 times a year now. Pre-COVID, it was about 3.5. So it's still turning. Supply is coming back, but we play in fragmented distribution. So, why Ford in auto might be able to turn on another plant and correct supply really, really quickly, that's not going to happen in the caravan industry, where, you've got 100 manufacturers that are Australian based and turn over between $20 and $150 million each. It's going to take them longer to get their supply back. So, yeah, it's really unique. The dealers did really well through COVID from what they were able to sell. They're coming to this with a lot of cash. Demand is obviously dropping, but stock is still normalizing. We talk about a lot, Rob, is how much they're stocking relative to the limits or funding we provide them. Back pre-COVID, that was about 65% of stock at any one point in time. It's only got back to 50. It was as low as 20. So there's still huge tailwinds for MitchCap. And our latest Equifax scores of our dealer portfolio came out the other day. On a weighted average basis, the internal rating agencies say that our SME customer base is actually getting stronger. So the scoring improved, the book is prime. So at this point, risk will obviously increase, but it's a better time for us in terms of stocking opportunity and therefore demand and revenue for us. Everything's going well, but we'll stay really, really close to our clients and make sure if the doomsayers are more right than wrong, then we're right on top of it. We're supporting our customers through if it becomes more of a drastic downturn that we've seen so far.
Okay, no, thanks for that. It's probably a bit more optimistic than what you read in the front page of the papers in for many sectors, what you've just provided there. But if we look to drill down, I suppose, into your own respective businesses a little bit more with regards to wherever we are in whatever cycle we're in at the moment, what are the kind of key things that you're focusing your attention on? And I suppose the second part to that, if there was one thing you could change about either the industries you operate in or your businesses themselves, what would that be? Start with you, Andrew.
Look, we've grown pretty rapidly through acquisition. In our group, we've got 520 people and 56 legal entities. We're trying to simplify, drop out some companies, consolidate, make it easier to manage. But with so many people, there is the issue that we've got is there's a lot of salary increases with the underlying inflation. Lots of and justifiably so, people are putting their hand up for more money, and that's our top line is growing, but our cost base is growing as well. And the real complexity is there's poaching. People are coming in frequently in the last 6 months saying, I've been offered 20 or 30% more to go somewhere else. And it's a real dilemma because the easy option is to say, okay, I'll match what the offer is at the other potential employer, but then it reprices everybody else because you give one guy or one person a pay rise and everybody in their team, it only takes a nanosecond for that news to filter out through the workplace. So it's a real tension in terms of keeping and remunerating staff properly, but without letting it run away from you. So that's probably that's one big thing for me. This data protection and cyber is also is a key focus for us at the moment. When you look at all the information that businesses capture about customers and us in particular being a broker, you lift the walls of your house to stop the bad guys getting in, but you can't really stop them. All you can do is make your walls a little bit higher than the next door neighbours. So if the bad guys show up, they go next door. But you just got to keep lifting those walls, make it harder and harder. But that's a key area of focus. But on the positive, there's plenty of business and plenty of flow and plenty of activity. It's more about how you deliver it rather than getting the flows.
Yeah. Okay. And to you, Paul, you're trying to raise your walls as high as possible, or?
I think everything Andrew said is spot on. Yeah, and it's exactly right. There is a general nervousness across any executive that I speak to at the moment about what we can do in terms of IT, security, data protection, data privacy, and it's be a great business to be in because nobody seems to have all the answers, and with Telstra and Optus and Latitude, Medibank having these issues, then certainly a small cap with smaller budgets who also collects a lot of data is going to be facing similar issues with smaller budgets, right? So that's absolutely a focus of ours as well, Andrew, and something that keeps me up at night a lot. And yeah, we've definitely got the cement mixers going and the bricks getting laid and trying to get our wall to be as high as COGs. So they keep moving past both of us. So yeah, but that's definitely a worry. And then, in terms of I'm a very aspirational CEO and excited about the journey ahead of us. So what would I love to be doing more on? It's more with our data and the opportunity that provides us. At any one day, we've got 5,000 pieces of equipment spread across nearly 300 dealers available to sell to consumers every day. We buy about $60 million of new equipment on behalf of dealers across the market every month, and they're selling about 50 million of that to about 1,500 consumers on a monthly basis. So it's pretty big, that data opportunity in that channel that we own. How do we as a business, on limited budgets, limited people, and making sure our core business is still going well, really start getting into that data and using it to our advantage to create more of a defensible moat and leverage it into more revenue streams. That's certainly, the thing I would love to do more. We'd have more of a technology budget, more of a focus on creating those ecosystems benefits we see that are really unique to the business and unlocking that and finding the right people to be able to do that. It's difficult too. It's really niche talent in a market, as Andrew said, is pretty tight on people still, which is another reflection of maybe the economy. It is certainly not what it was, but there's certainly still demand for highly skilled people. So finding those sort of people on a budget and getting them into MitchCap and helping us on that data and ecosystem journey is something that's a major focus for us and something we'd love to change quicker than we can.
Okay, and I'm sure you're not alone with either of your thoughts there regarding technology and how it can benefit yourselves. Every company we speak to, technology is a key focus, and we've heard that from some of the other presenters today. I might just take a step back, and I might start with you first, Paul, on this one. In terms of globally, do you think with regards to the industries that you're operating in, are there any learnings or benefits that you think we can bring back to Australia that could obviously benefit either, as I said, your specific industries or the economy as a whole? I'd love to get your thoughts, starting with you, Paul.
Yeah, thanks, Rob. From our customers' point of view, so this is quite interesting. It's probably a bit of a no from a customer point of view. So I'm talking about the caravan manufacturer, the boat manufacturer, the caravan dealer, the boat dealer. If you look at those industries, they're highly fragmented. No Australian manufacturers still dominate large parts of those markets, right? But none of those Australian manufacturers have really had great success penetrating at the moment into North America or Europe. And vice versa, the American manufacturers in those industries, within region, particularly in caravans, haven't really had a great penetration of the Aussie market. They're very unique to their regional poles at this moment. So, for those guys learning from overseas, it's probably not a 3 to 5 year great benefit from them spending more and more time in the North American market. You would argue, if you thought about auto, that would be completely different because, their ability to scale and invest in machine learning and stuff, because it's no longer fragmented, they're big and they're concentrated, then there would be a lot of learnings. But I think, the artesian nature of some of the industries we play in, albeit they're still big. I mean, there's $5 billion of caravans and RVs sold in this country every year, right? But they're still relatively artesian, and I think there's some great barriers protecting Aussie businesses in those channels. In terms of MitchCap, really quickly, yeah, absolutely. We're really taking, my predecessor, where I used to work, GE Capital, had the lion's share of this market before exiting. I compete really only against one regional Aussie bank and two others that are global, one being a North American bank and one being a European bank. So, we really are taking the first fragmented equipment distribution finance book to the Australian market. And certainly, that puts us on a journey on educating, our key stakeholders, our banks, our credit funds, our investors on, the great opportunity and the importance of this product to the success and the viability, of caravan and boat distribution in this country, right? So, I think, looking overseas is really all we can do in that education panel, where there is significant businesses like MitchCap already who have been able to go through securitization, have lowered their cost of funds, have got significant investment in them and been able to grow off the back of that. Certainly that's all upside and opportunity for MitchCap, but certainly, there's some great overseas examples that could, if there was more understanding and education in the Aussie market, that could really expedite our growth.
Okay. And to you, Andrew, the same question.
Look, in terms of the way we run our business and our customers operate, probably not so much. The learnings when I look overseas and the way it impacts our business is when we look overseas, there's just a mountain of sovereign debt. Everyone's just leveraged, nation states leverage to the gunnels with debt. And debt or leverage magnifies risk. So, I get a little bit of pressure, should borrow more, buy more business, leverage the balance sheet, because we have very low levels of core debt on our balance sheet. But COG as an organisation, we're pretty conservative. We don't like the idea of having a lot of leverage because, it magnifies returns. But, globally stuff can just the sheer volume of debt makes the global scene a little bit challenging. And you only need something to happen somewhere. You've seen it, Silicon Valley Bank, quite good banks unravel very quickly on the back of sentiment. And so I guess the way it's flowing through to us is just not a total aversion to debt, but using it very, very sparingly.
Okay. And I'm just jumping into a couple of questions that have come through here. Andrew, I might start with you on this one. The impact of electrification on vehicles. I know it's an area that COG certainly has some tentacles into. And if you look at the Australian market, I think we're at 6% of new sales. New Zealand's at 20%. Rest of the world as an average is about 14 to 15. So we're clearly behind the 8 ball here. But how do you see the electrification of vehicles, I suppose, more generally for this economy over the medium to longer term?
Well, we've got a novated leasing business, or a couple of them wrapped into one, but the government's got this new, since about November last year, where if you take a novated or salary sacrifice vehicle, it's free of FBT, and the volumes there are just, growing very, very strongly. The issue there is just getting the vehicles in the country. But you look at the car sales for April. Tesla did something like, I can't remember the exact numbers, but 4,000 or 5,000 units. 12 months ago, they did 50. But on the other side, you see Toyota 12 months ago did 15,000 or 16,000 units in the month. And this month, or in April, they did 4,000 less. They did 12,000 units. So, and look, there might be other factors at work in terms of Toyota supply chain issues, but you can see just in the raw numbers that electric vehicles, motor cars, are growing very strongly. And, if Australia is going to meet these greenhouse gas reduction emission targets that the government set, 82%, I think, by 2030, all the cars are going to have to be electric. Otherwise, you better start buying air conditioning units because it's going to get very hot here.
Hopefully we can all avoid that. And Paul, I suppose the auto industry might be a little bit ahead of time with regards to the recreational vehicle industry. But yeah, I suppose the same question for you, electrification of caravans. And I don't know if I'd want to be on an electric boat, but how that is, if at all, playing out within your industry as well at the moment.
Yeah, well, it's coming. Based on what Andrew said, I'll probably go and buy my last diesel ute now, enjoy it while we can. But yeah, look, in our industries, There's some really cool stuff going on in electrification. Obviously a caravan gets towed, so we do keep an eye, maybe not to the same level as Andrew does, on electrification of towing vehicles, because obviously they need to be strong and powerful and robust if they're going to continue to pull the caravan. There's some really cool stuff going on in Australia actually on electrification of caravans. With new technology coming in, new battery packs and stuff that actually helps reduce the pull on the cars and from everything from how they how much energy they need to operate while they're off grid, to helping with momentum while moving, to reporting diagnostics and everything. So it's pretty cool. We're already seeing the percentage of assets we fund across every industry we're in, right? So bicycles, the e-bike segment went bananas through COVID. It's going through that phase where as someone who funds equipment through that while it's held as inventory, we've had to be really careful on who we back and who we don't back, because it's still in that industry of, the better players hasn't quite been worked out who's going to be the long-term players in that market. And, the quality is quite, it's quite dispersed. There's some really, really good stuff out there, and there's some stuff that isn't great. So, that's been interesting from a valuations point of view and making sure we're backing winners and stuff that's saleable. Certainly it's growing in motorcycles because it's a bit more like auto, and we fund, some really cool electric motorcycle brands. One being Australian made with Fons Moto. We do Super Soco for the Urban Moto Import guys, which are a couple of brands people would see around. That's, they're growing shares in their markets every day, which is really cool. And, in the boat game, it's probably a little bit behind, but, it will be important. Our book is in order in marine is largely tilted towards outboard engine trailable watercraft, right? So, you're seeing Mercury and you're seeing Yamaha and there's a couple other players specialising in electric outboard engines for boats, and it's coming. They're really at their first generation now. But those big guys, they're investing a lot of money in electrification of outboards. And whilst Mercury and Yamaha are not clients of MitchCap, the boats they go on the back on are. So, that's going to be an important part for our dealers who, make a lot of money, obviously combining that into a boat motor trailer package and selling it off, and then obviously managing their carbon footprints of the life cycle of their products in use going forward. So lots happening. For us, it's making sure we're backing proven technology, funding equipment that's, going to do what it says it's going to do. And, electrification brings a little bit of risk, but an exciting opportunity at the same point in that regard.
Well, I bought an electric Mini, and I'll give David Dicker a run from a start up to 60 k's an hour. Geez, those things fly.
Very cool.
He might be able to swap Ferraris halfway through the race and keep going and catch you up. So
I plugged two. I feel bad for the other one. We also fund Benzina Zero, which is another really cool Australian startup doing some great things in electric motorcycles. So I just thought I'd better plug them in case any of my customers that come on. I love you all equally.
Well said, Paul. Gents, that's we're butting right up on time here. Whilst we could talk all day, I'll have to call it there. So to both of you, thanks very much for dialing in and sharing some of the views on the industries in which you operate. It was great to chat. So no doubt the listeners will be very thankful for that. So thanks very much.
Thank you.
Thanks, Rob. Appreciate it, mate. Yes.
And with that, I will hand it back to both Owen and Sebastian to wrap it up.
Thanks, Rob. That was really insightful. I got heaps from both of those gents, just to hear him speak candidly about that too. Sebastian, I will share a slide in just a second of how people can stay up to date, because you guys at NAOS do this regularly. But maybe if I could just ask you for any kind of takeaways you got from the presentation today.
Yeah, I mean, I suppose the conundrum of being an investor springs to mind. But yeah, I think it's what I grapple with every day, to be honest. I think talking to some of these people, and are very seasoned, and I've got a lot of respect for all of them. I think it's interesting they see there's a relative, like Rob said, there's an amount of optimism. And obviously that optimism hasn't sort of flowed through to share prices. But I think, what it does tell me is longer term, I think there's a lot of potential upside, for not just these businesses, but for many Australian or even New Zealand listed businesses. I think if they're run by good people with sound plans, they're dynamic, they can adjust, and they're funded. I think funding's the big one. They're not too stressed. They don't have too much debt. I think the sky's the limit, and that's the beauty of investing. Some of these businesses. You look at David Dicker's business. You look at where Chris was at Main Freight. They literally, like you said, started from nothing and became something that's worth multiple billions of dollars. So that's the exciting part of investing, I think.
Absolutely.
We're in a part of a cycle, and maybe that's the opportunity. Maybe everyone is slightly a little bit too negative.
I would agree with that. It was actually really great to hear Chris and Peter in particular say, and I'll paraphrase for them, but just that they're looking through the cycle and they've seen this rodeo before, they've been here, and that was kind of reassuring. But then also, I think one thing I'll take away is the intense focus across the board on cybersecurity and the importance. It's a dynamic which pulls both ways, which is we want to invest in technology to make the most of it. But at the same time, we're extremely cautious about the data that we collect. I think all of our speakers really brought that to the fore, which obviously is both an opportunity and a challenge. But I love doing these things, Seb. So I really do appreciate you and the team at NAOS putting this together and getting so many great speakers together and sharing that with the Rask community in particular. But there is a link for anyone that wants to follow up with the NAOS team or learn more about the LICs. There's a link in the episode description. You can just click that. You do like a weekly CEO Insights newsletter, if I'm not mistaken, Seb?
Yeah, we do. Once a week, we put a list together of just quotes from around the world we think are interesting. We do a quarterly webinar. We do a yearly roadshow. We might do another one of these eventually if we can stay efficient. And believe it or not, we get lots of people emailing us directly for all sorts of questions. So I did see a question that was for MaxiParts. So I'll forward that on to Pete and hopefully get an answer today.
Yeah, great. No, I really appreciate that. You guys are always super shareholder friendly and do a great job at connecting investors to these wonderful CEOs. So without further ado, mate, we can say goodbye to everyone. We hope you have a wonderful day. Thank you for joining us. If you've joined us live, if you're on replay, thank you so much for that. Bye for now. And I guess we'll see you next time. Thanks, Seb.
Thank you. Thanks, Owen. All the best.